Welcome. We're going to get started in a few minutes. We're just waiting for a few more people to log in. My name is Corbin Lindsay with Birdseye Financial. This is Savvy Social Security Planning, and I look forward to spending the next 45 minutes with you. But if you can just hold on a few more minutes, we have some people logging in. A lot of times people log in about a minute behind, trying to figure out their computers. But thank you for coming to our workshop tonight. This will be educational only, as I will explain a little bit later. And I look forward to sharing with you some of the ways that you can increase your Social Security benefits. Maybe you have been through some different seminars, workshops. Hopefully I provide you with some benefit that you're going to find worth your time tonight. So just a few more minutes and we will get started. Why don't you go to the chat box if you can and let me know where you're from. Let me know what state, what city that you're from. It'd be nice to know who is with me tonight. We have this happening in about 5 states tonight. I do see some people from Texas. Anybody? Oh, okay. Dallas, Texas. Looks like Southern California, Laguna Beach, Orange County. Anybody from Idaho? Okay, Seattle. That's not Idaho, but close enough. I'm up here in Washington myself, just north of Seattle, and we're going to get started really soon here. Okay, somebody from Arizona. Nice. I used to live in Arizona for 3.5 years. I bet it's pretty hot down there right now. Okay, well, let's give them another 15 seconds and then we will start our workshop. Thank you again for being a part of this event, and let's go ahead and get started with our event. Good evening. My name is Corbin Lindsay and I will be your presenter tonight. My role is to share with you how you can maximize your earned benefits through Social Security. After 19 years in the financial services industry, I've learned a few things. I found that in the industry, most advisors spend more time selling products rather than educating, analyzing, and servicing their clients' needs. Here at Birdseye Financial, I've spent 19 years as the owner of the company, helping strategize, educate, analyze, and service my clients with pension plans, tax strategies, RMD strategies, investments, safe growth, and more. But for tonight's webinar, we're going to focus strictly on Social Security. This event is designed for you. It's an educational only event, so the information that you see presented should not be considered as advice. However, I want to provide you with a whole lot of value just for taking the time out of your busy schedule tonight. So I have a special offer for you just for attending this webinar. We will discuss the special offer in just a few minutes, but first, let's get started. Tonight's webinar is titled Savvy Social Security Planning. What most people do not realize about Social Security is that there are hundreds of different ways that you can take your Social Security. And sometimes that difference between the number 1 and the number 2 best way out of 100 different options can literally be $100,000 or more of additional income that you receive over the course of your lifetime. This is why we've chosen this topic tonight to be discussing it for the next 30 minutes or so. This is going to be quite important, and essentially, for some, the decision that you make, that once-in-a-lifetime decision on when to take Social Security and how to take it, could be one of the most important decisions that you make. First, regarding this webinar, it is a live event, so if you have questions, we ask that you hold them to the end. There is a chat feature available on your screen, and you can type in whatever your question is. However, I have personally found that it's always best to watch my presentation to the very end, and if you still have questions, you can submit the question and we will try to answer them at the end of this webinar. The reason we typically save the questions to the very end is that we don't want to break up the flow of this vital information. If we do not reach your question, because there are a lot of attendees tonight, you can always submit your question to our office via email or phone. Our contact information will be on the next slide. Next, I encourage you to try to stay focused. So please, please, please try to turn off any distractions, such as close out of any other windows that you might have, or silence your phone, so that this information that you receive tonight can be put to good use. Here's the information to reach my office if you have any questions. You can call us at 360-722-7889 or send us an email at info@bird'seyefinancial.com, and we will be more than glad to answer your specific questions that relate to your situation. Now tonight, we're going to focus on 5 basic questions that baby boomers most want answered, such as, will Social Security be there for me? How much can I expect to receive from Social Security? When should I apply for Social Security? And my favorite and the most popular question, how can I maximize my benefits? After all, that's the most important part to Social Security, isn't it? And last, will Social Security be enough to live on in retirement? And I think if you're smart enough to be here on this workshop webinar tonight, you probably know the answer is no. Social Security alone is not enough to live on for most of us. So to help you along this path and to make the proper decisions, if you stay until the very end of our educational event tonight, you're going to receive a special offer. And that special offer is a customized personal report with your own personalized income options and how you can best maximize your Social Security. Now, this is something that the Social Security Administration cannot do for you. They can give you some basic information, but they simply can't go out on a limb and make any recommendations or any type of planning offers. Often I'm asked why I offer this level of service to my clients, and the question is very personal to me. Here's the reason. Step back with me for just a moment into 1968 when I was born. My parents tried to figure out how to raise a family and provide for us kids, and they saved for retirement. But an unfortunate situation occurred when I was in the 7th grade. The year was 1981. My father died of a brain aneurysm. So my mother was left to care for my brother and I with no roadmap or idea what to do. Well, she ended up going to a local stockbroker, and he gladly offered to invest the little money she received from life insurance and put it into the stock market. Well, with the ups and downs and no idea what she was doing with managing her money, the money did not last very long. She began to work 2 jobs just to pay the bills. Life was not what she had planned. In fact, there really was no plan in place at all. After all, she was only 46. So my goal here at Bird's Eye Financial has been to help everyone I know solve the income issue. How do we maximize the amount of income we have through every option available, including Social Security? Some people may ask, what did my mother do? Well, she continued work, moving up the corporate ladder, getting herself a 401k, a pension, and Social Security. But what happened next was very important. She was able to learn more about Social Security strategies, much like I'm teaching you tonight. This allowed her to maximize her earnings beyond what she thought was possible. My mother is the primary reason why I'm teaching you this information tonight. It's very possible that some of you on this webinar need to learn how to maximize your Social Security benefits because it may directly help you too. So let's take a look. Let's start with the basics. So when is full retirement age? Well, full retirement age is between the age of 66 and 67, depending on the year in which you were born. So if you look at the bottom of this chart, you will see that if you're born after 1960, your full retirement age is 67. And if you're born before 1954, it will be 66. And between 1954 and 1960, your full retirement age is somewhere in the middle. Now that's when you get full benefits at those ages. But as you can see on this chart, you can apply for benefits early, however you will get a reduction. For example, if your full retirement age is 66 because of your birth year and you take it at 62, you will receive a 25% reduction, essentially 75% of the benefits. However, if your full retirement age is 67, then you get a 70% of the benefits. That's a 30% reduction. So you can choose to take benefits early, but you do get a significant reduction for doing so. But the good news is that you can also choose to take benefits even later and earn more income. If you take them after the full retirement age, you essentially get an extra 8% per year simple interest increase in benefits for every year that you wait. So if your standard age is 66 and you wait until age 70, then you get an extra 32%. If it's 67 and you wait until age 70, then you get an extra 24%. So let's take a look at how that all works, how it all comes together between taking it on time, taking it early, or taking it late. Let's take a look at the column that says benefits without cost of living. If you take a look at age 62, the maximum PIA, which by the way, if you take a look down at the very bottom of the page, the maximum primary insurance amount, which is the amount that you get at full retirement, age 66 or 67. Today, that maximum is $3,142. This is called your PIA, your primary insurance amount. In fact, I encourage you to write that down. PIA, primary insurance amount. We're going to be talking about that a little bit later, and it's important. So again, that's the amount that you take that you get at your full retirement, whether it be 66 or 67 if you qualify for the full benefits. So in that column that says benefits without cost of living, it says that if you're that person and you take it early, let's say at age 62, you get the $2,356 a month. Again, that's a 25% reduction. Then if you took it late, however, at age 70, you get a 32% extra. Now your benefit jumps all the way up to $4,147. So by simply waiting 8 years, you essentially get almost double the benefits. Now let's go to that right-hand column, the one that says benefits with cost of living. Why do I have that on here? Because historically, Social Security has given an average cost of living of 2.7% a year. That makes the difference between taking it early and taking it late so much greater. So if you look at the graph at age 62, the benefits for the person would be $2,356. Basically, it's the same whether you take it with or without cost of living. But if you choose to wait until age 70, your benefit, instead of being $4,147 per month at age 70, it's now $5,132. It's $1,000 a month more because the cost of living raise compounds even further if you resort to taking the Social Security at a later date. So in this case, instead of receiving $2,356 a month, you would have $5,132. You get more than double the benefit by waiting 8 years. And remember that term, PIA, primary insurance amount. It's the amount that you get at full retirement age, regardless if it's 66, 67, or somewhere in between. One important step for everyone on the webinar tonight is to go visit Social Security Administration. The website is ssa.gov and get your annual statement. It used to be that those statements were mailed out to you prior to your birthday every year, and they would show the income projections. Well, just like every other business, they want to save money, so they stopped sending them out. But if you go to their website, you can put in your personal information and it will pull up your benefit statement. You will want to find out what your primary insurance amount is, because that's the only piece of information that we need in order to provide you a personalized scenario analysis. This personalized report is yours to help you maximize your Social Security benefits. We will need the PIA number, the full amount of the benefit that you get based on your current income at age 66 or 67. So again, write that down please. ssa.gov and get your PIA amount. You're going to want to know if there's any mistakes. You're going to want to check to see if there's any missing years, if the income that they have listed is incorrect. You don't want to wait until the very last minute to find that out. You want to find that out as soon as possible. Now, Social Security also has a couple of tools on their website which give you the ability to create different scenarios, but they're very limited. They're not nearly as robust as the private program that we use in order to help determine the different kinds of scenarios for you that you can maximize your benefits with. If you're single, it's pretty simple, right? You're looking at how long do I think I'll live? Should I take it at 62 or wait until 70? The calculation should be an easy break-even analysis, but you may want to take a look at taxes and whether you'll still be working. But it's become easier decision when you're single than when you're married. There's still a lot of other factors, but it's not incredibly complicated. If you're married, it just got complicated because of these things called spousal benefits. That's when one spouse has a higher benefit than the other. The lower earning spouse gets the higher of his or her benefits, or one half of the higher earning spouse's benefit. So let's say if the lower earning spouse didn't work at all, didn't even earn any Social Security credits, well, that's okay because he or she can still qualify for an additional half benefit of the higher earning spouse's work. Let's take Joe for example. Joe is making $2,000 on Social Security. His wife, Julie, is making $800. This is what they would receive at full retirement age. But because Julie's amount is less than half, that if Julie applies at full retirement age, her benefit gets bumped up to $1,000. That's 50% of Joe's. Now, there are some rules for spousal benefits that you're going to want to be aware of. Let's cover the rules of the spousal benefits. First, in order to get the primary income worker must have already filed for benefits. Second, the spouse must be at least 62 years of age. Even to get a reduced spousal benefit, it cannot be taken prior to age 62. And third, there's no delayed credits on spousal benefits. So if you're taking a spousal benefit on your full retirement age of 66, you don't want to wait until age 70. It doesn't give you any extra benefit, and there's no reason to do that. Last, now you have something called filing for restricted application. It's a creative strategy where you can get a little bit more benefit from this. It essentially means that one spouse can take the spousal option while the other spouse lets his or hers grow and delay all the way until age 70. But in order to do this, you've got to be at the full retirement age. The higher earning spouse has to also be at full retirement age. You have to have been born before January 1st, 1954, and so on and so on. So again, it's restricted. Some people can do it and some can't. But it's a great potential benefit for those who can. Then you have divorce spousal benefits. Divorce spousal benefits are just like what they sound. So if a person who is married is now divorced and is claiming spousal benefits on their ex-spouse, there are some general rules to follow. You have to have been married for at least 10 years or more, so it can't be a short-term marriage. It's got to be considered a long-term marriage. Next, the person receiving the benefits can't have gotten remarried. They still must remain single. If they get remarried, they're going to lose the benefits. You've probably known somebody in your circle of friends who has been together for a long time and they won't get remarried. Why? Because they know that the new spouse does not make as much as the old spouse. So the spousal benefit is higher off of the old spouse and they just choose to not get married. They choose to live together because there's more money involved. I sure wish they would fix the system. Now the ex-spouse is at least 62. And finally, if the divorce was less than 2 years ago, then the ex-spouse doesn't need to know. Doesn't even need to file for such benefits. So here's the thing. If it's more than 2 years, then it doesn't really matter whether the higher earning spouse took them or not. The bottom line is the lower earning spouse can now get those spousal benefits. Here are some additional rules. A lot of spouses can collect off of one unfortunate high earning divorcee. So if you're unlucky in love, as they say, and you've been married, say, 4 times for 10 years each, it's possible that you could have 4 ex-spouses collecting off your benefits. The good news, though, is that it doesn't affect the benefits paid to you, regardless if you're the higher earning spouse or a current lower earning spouse, or even if you're one of the ex-spouses. It doesn't affect anybody in any way. And the divorce spousal benefits, of course, end upon remarriage of the person collecting the spousal benefit. So again, same thing, you've got to be single to get them, and if you get remarried, they stop. And you have to go back to collecting your own, which may be likely lower. So far, we've talked about spousal benefits, divorce spousal benefits, but what about survivor benefits? Survivor benefits occur when one spouse dies. The lower spouse gives up his or her benefit and switches to the benefit of the higher earning spouse only when that spouse is no longer alive. So let's get back to our favorite couple, Julie and Joe. They're married. They're both over the full retirement age. Joe's benefit is $2,000 a month and Julie's is $1,200 a month. So first, Julie's not taking a spousal benefit because Julie got $1,200 on her own. Why would she take a spousal benefit of only $1,000? It wouldn't make any sense. By now, all of a sudden, Joe dies. So Julie notifies the Social Security Administration and her $1,200 steps up to the $2,000. She gives up hers and ends up getting Joe's. Here are some of the rules for survivor benefits. The couple must be married for at least 9 months by the date of death, except for in a case of an accident. So again, of course, the Social Security Administration doesn't want anyone to game the system, and in theory, somebody could have a high benefit and could create a deal with somebody, a financial deal, where they say, hey, I'll make sure the kids get some of the money. What if I marry you since you have 1 foot in the grave and 1 foot on a banana peel? Obviously, they don't want to have this happen. So, second item is the survivor must be at least age 60 to qualify for these benefits. And third, the survivor benefits are not available if there is a remarriage prior to age 60. So again, the same thing, you can't be remarried. And last, and of course, the benefits are similar to those of divorce benefits. That means that the marriage must have lasted for at least 10 years. Well, that's it for the survivor benefits. Now for a little bit of humor. If you're a baby boomer, this might feel like what the whole system is like. Well, here at Bird's Eye Financial, we work hard to show you your options and provide you with a retirement analysis, a tax analysis, and even a Social Security analysis in order to show you how you can get the most out of your money. These are the strategies that I think are going to help you improve things just a little bit. So the first thing in improving your earnings record is making sure that you've gone to the website that I mentioned earlier, the ssa.gov website. A lot of times the earnings are wrong. So for example, in one of our workshops just a couple weeks ago, I had a business owner who he and his wife had a successful business and the majority of the income was under his name. It didn't matter, they're married. So she didn't accrue enough credits. So what we told them was, look, you're maxed out. Why don't you shift some of your income to your wife? Let's build up her credits. So the next year she can have even more credits of her own. In addition to that, like I said before, you want to know if your earnings records are accurate. Sometimes they make mistakes. Don't wait until you're ready to push the button to collect your benefits. Sometimes it's too late. You want to know as soon as possible. If it's not accurate, you have time to get it fixed. Also, there are some missing years. Many times they put a 0 down because they don't have your report, and those can affect your benefits adversely. So with the missing years, you want to get those fixed as soon as possible. Can you improve it by working longer? Some people want to do that. They say, I took some time off and maybe it's to raise a family and maybe I just want to go back and work a little longer. In some way, shape, or form, I want to get some of those 0 years wiped out. The great way for maximizing the benefits is in strategy number 2. This is taking it at the right time. So there's a lot of things to consider here. In fact, even if you're single. So for example, you may need to think about your income needs, both now and in the future. It's great to take it at a certain time, but if you can't afford to live on that, it doesn't do you any good. Next, you have to think about your life expectancy. Reasonably speaking, in your family, do people live long or do they die early? If people die early, then maybe you should bet against yourself and take it at age 62. If people live long, maybe you might want to wait until age 70. That's up to you. So in addition to considering your income needs now and in the future, you should also consider your life expectancy. How about your spouse's life expectancy? Remember, with the spousal benefit, sometimes the higher earning spouse, the benefit pays until both of you are gone. That's a big part of your decision too. There's a lot of moving parts. You also want to think about your plan for future employment. Are you going to continue to work or not? If you are, you're going to make sure that you're under a certain threshold, or if you're over that threshold, which we're covering in just a moment. Also, your tax bracket is a big part. So, what if you do plan to work? What are the implications? Well, if you apply for Social Security before full retirement age and you decide to continue working, then for every dollar that you earn over $18,240, you give up 50 cents of your money to Social Security. You can work and you can make over that amount, but you have to give part of the benefit back at the end of the year. Now, your benefit will be somewhat adjusted upward at the full retirement age, but for all practical purposes, if you're going to work and make a significant amount of money, more than $18,240, then you don't really want to take Social Security early. As a practical matter, you want to try to turn it on as late as you can. Well, now comes the government's involvement. How many on this webinar tonight feel that this is how the IRS treats you? Go ahead and say yes in the chat line and let me know if you feel this way with the IRS. Now we're going to focus on taxation of Social Security. Did you know that Social Security benefits can be taxed at all ages? And it's not just a function of the income from work, it's a function of all your total income from all sources. Sources like pensions, IRA distributions, interest and dividends, and so on and so on. So if you look at the bottom of my screen, the IRS has a coined term, which is the IRS code called provisional income. Provisional income is your adjusted gross income, plus 1/2 of your Social Security benefits, plus your municipal bond interest. That is considered your tax-free interest. If that number is over any of the numbers on my screen, then that part of your Social Security benefits will be taxable. They will not be tax-free. So let's take a look at the top part. If you happen to be married filing jointly, and that your provisional income is under $32,000, then you pay zero tax, that's additional tax, on your Social Security benefits. If your number's $32,000 to $44,000, then you might have to claim up to 50% of your benefits as taxable. But if that income is over $44,000, which is not a lot for a married couple filing jointly, when you include half the Social Security benefit, it's now up to 85% of your benefits can be taxable. Now that doesn't mean that the tax is 85%, it just simply means that 85% of your benefit has to be claimed as taxable income on your return. So let's talk about the maximization strategy. When you have one spouse, a low earning spouse, that's more than 50% of the higher earning spouse, ideally most spouses want to delay until age 70 because the lower earning spouse isn't going to take the spousal benefit because his or her benefit is more than half. And if they're going to live long, they're going to want to wait and delay until age 70. One spouse can take advantage of the spousal benefit as allowed that actually maximizes lifetime benefits over the average of both life expectancies. Here's what would happen. If the lower income spouse would take his or her benefits, the higher income spouse would claim spousal benefits on the lower income spouse. So now, instead of waiting all the way until age 70, the lower income spouse is taking his or her benefits, and the higher income spouse is taking only half of that. Then at age 70, the higher income spouse could step up his or her benefits, and at that point, so can the lower income spouse. So essentially, what's happening is you've gotten your ability to delay to a later age because you've decided to do that. But you've gotten money for both of you for many, many years in between. Again, this is a really neat maximization strategy. So we've talked about taxes, and obviously you want to minimize the taxes on Social Security benefits. Here are some of the things that you can do to minimize your taxes. You can reduce other sources of income. You can anticipate your required minimum distributions, otherwise as known as RMDs, and other types of withdrawals. You can convert traditional IRA funds into a Roth IRA. You can delay your Social Security. You can reduce expenses and pay down debt. And of course, you've got to continue managing your taxes throughout retirement. It's not a one-time thing, it's a continuous thing. Now, here's what's important. We've got to consider this decision in context of other income like pensions and IRAs and 401ks and those RMDs that we collect at now age 72, investment portfolios, and if you still have employment. Social Security doesn't stand alone. It's got to be taken in accommodation with everything else. Obviously, you can't retire exclusively on Social Security at full retirement age, let alone at age 62. And here's the bottom line with investments. There are 3 stages of investing. There's the accumulation stage, the transition stage, and the distribution stage. Now, we all know the accumulation is when we're working and saving money, and the distribution phase is when we're pulling money out. But how about this transition stage? That's the stage when you're within 10 years of retirement and you want to slowly start making a transition in your portfolio. This is one of the critical shifts that everyone should be making 10 years out from retirement. But I have to tell you that many people delay it. In fact, they don't even do it on time. And some don't even do it at all. In my 19 years of experience as being a financial advisor, this is one of the biggest failures that people make, and it's a critical shift. It's one of the biggest mistakes I see people doing year after year. Not just with their Social Security planning, but with their retirement planning in general. So what do we mean? Well, as we go from the accumulation into transition and ultimately into distribution phase of life, one of the main considerations that people should be thinking about is investing for income, not for growth. You have to think about it for a second. Are you really invested properly, or are you not? What are the 3 stages of life? When was the last time that you looked at your portfolio this way? Or will you put yourself into a situation where you're still invested for growth, but now you're retired? So when you want and need income, you're forced to sell shares from your 401k, your IRAs, and your brokerage accounts. We all know the rule of buy low and sell high. And when you take money out of the market, will you be able to guarantee that that particular year or every year is an up year? Or will you be forced to sell in a down market, which violates the very basic rules of investments? The alternative is to invest for income, consistent dividends and interest. So what do we mean? Well, in my world of investments, we have a certain equation, and it's called TR equals I plus G. This stands for total return equals income plus growth. Income and interest and dividends is what pays out to you, and growth is when you buy something at a certain price and it goes up in value. Making that transition from G to the I is a critical shift, as I talked about just a moment ago. So when you're going to look at your different stages of life, let's consider someone who's young and they're in the accumulation stage. All they care about is total return. You want to make money on your money. You don't really care where it comes from, if it's interest or dividends or from growth. But when you retire, you're in the distribution phase now. You now care about both growth and income. You don't really care about just growth of total return. You care about how much income those investments can pay out and for how long. In that transition phase, 10 years before you retire, that's when you want to make sure that you're making a gradual shift, a philosophy from G to I with your money, from growth to income. And here's why. Since the turn of the century, the first 20 years, the Dow Jones Industrial Average, it averaged out at 5.8%. So let's say that you retired January 1st of 2000 and you had $1 million, just for a round number. You wanted to take $40,000 a year out of it, but you made the mistake of leaving your money in your 401k, leaving it in the mutual funds. And you say, well, I want to withdraw $40,000 a year from that $1 million. Surely if I'm making an average of 5.8% over 20 years and I'm only withdrawing 4%, I'm fine, correct? I should be able to still grow my $1 million. Well, surprising to many, it just doesn't work that way. This strategy is what I call the withdrawal method. I also call it engineering retirement income. Some of you might have heard it under a different phrase called sequence of returns. Well, using the withdrawal method when you're retired in the distribution phase is one of the most cancerous retirement strategies any retiree can embark upon. Now let's take a look at this scenario, the withdrawal method of engineered retirement income. On this first scenario, you start out with, say, $1 million, and you're taking out $40,000 per year. And in 19 years, you have a balance of $345,652. Remember that number for a second. My second scenario is called the true income method. You start out with $1 million, you receive an income of $40,000, and in 19 years, your balance is $1 million. So why don't more advisors talk about this? Well, because this is the picture that I believe best represents what most advisors have turned into. A lot of advisors today are essentially stock market cheerleaders. The market drops, you call them up, you tell them you want to get out, and they tell you to hang in there. And they use the old Wall Street cliches and say, you don't want to get out now. It's not about timing the market, it's about the time in the market. Or they might say to you, in the long run, the stock market outperforms everything else. All of these sales cliches that these advisors have learned from day one in the business to get you to invest in the stock market and to keep you invested in the stock market. And it should be of no surprise, right? Because these statements all originated back in the 80s and the 90s, and they were one of the best stock market times of history. And as a result, most advisors who are here today learned and were trained during that time period. And they became big stock market advocates. They became essentially stock market cheerleaders. And that's great if you're only in the accumulation phase of life, where you're only concerned about the total return and you have time on your side. But you don't need me to tell you that the closer you get to retirement and in retirement, you don't have that much time on your side anymore. And I believe that that's the reason you haven't heard these different two methods. Now here's the bottom line. For your Social Security decision, I doubt that I've had a chance to answer all of your questions tonight because we've covered a lot of material rather quickly. And frankly, there's much more material that we don't even have time to cover. Here at Bird's Eye Financial for the last 19 years, we've set ourselves apart from everyone else. We spend more time with education and analysis and following up with service from year to year. And we believe that it's important when you get started with Social Security or tax strategies or retirement planning that you test different scenarios to find out what produces the best results. We look at your specific situation and we offer the best scenario for you, whether it's money in the market, safe growth, income options, Social Security, pension maximization, or even tax strategies. We start first with the analysis, then we offer education. Then we build a plan around what works best for you. And just like it says at the top of my screen, your interest is our only interest. So tonight, we wanted to answer your questions. Questions like, when should you apply for Social Security? What if you want to keep working? What if you've already applied? How much benefit are you going to receive? How can you coordinate your spousal benefits between the two of you? Is there really going to be a popular option? And what's the best long-term strategy for your personal situation? And that's the most important thing. There is no one-size-fits-all or what's the best strategy. Each one depends on your personal situation, and most importantly, what should you do next? So congratulations, if you're still hearing my voice, it means that you've made it to the end of the webinar. And that special offer that I mentioned at the very start of the presentation is what we're going to wrap up with. This special offer is a customized personal report with your own personalized income options and how you can best maximize your Social Security. We're going to take the time to create this report for you so that you can make an informed decision on which Social Security distribution option works best for you. This report is yours to keep, and we know knowledge is power, and we want you to have this powerful report. So if you've watched this webinar to the end, as we've promised, we're going to give you this as a special offer. We will offer this personalized report at no cost to you if you make that request tonight. We are a full-service financial services agency that has been around for 19 years, and we've grown because we've taken time to educate, evaluate, and implement the strategies that retirees like yourself need in order to get the most benefit possible in retirement. What we ask is that you simply click on the link found in the chat box or at the bottom of this page. It will take you to my website where we will ask you to book an appointment with me. During this meeting, I will gather the details needed to produce your customized report. And during our next conversation, we will go over your personalized report, how to understand it, and how to implement the choice that you think is best, and how you and your spouse can benefit the most in retirement. Again, just click on the link in the chat box or at the bottom of this page and let us know of a good time which we can contact you and go over the details needed to put together your personalized Social Security report. Well, that concludes our meeting tonight. My name is Corbin Lindsay. My company is Bird's Eye Financial. Now let's take a few minutes and I will answer some of the questions that were entered into the chat box tonight. Please remember, if we don't get to your question, because there's a lot of attendees tonight, you can always send your question to us via email or call our office, and we make every effort to answer your questions. And in fact, if you schedule with us an appointment, not only will you have your questions answered, but you can also receive that personalized report. So just click on the box below this link or at the top of your chat box, the link for the personalized report. Now let's get to some of those questions. Okay, we have a few questions here. Let me look at some of them here. Let's see. This is a good question. How long must I be married for spousal benefits? As you probably recall in the webinar, it's age 62 and have been married for at least 10 years. Let's see, another good question. Can I suspend my Social Security and let it grow larger if I'm already taking the income? Well, that's kind of a two-part question. If you reached your FRA, you can voluntarily suspend your benefits to earn a delayed retirement credit through what that suspension period is, but no later than age 70. If you haven't yet reached the FRA, then you must wait until the FRA to suspend or withdraw your application entirely. Only if you're within 12 months of filing and you have not yet reached your FRA can you actually suspend it. Second part of it would be if someone was beyond FRA, so they're over their 66 or 67 age bracket, And then they can voluntarily suspend, but they cannot withdraw their application any longer. And the payback does not apply. At that point, they would only earn their monthly delayed credits. This is something that Social Security will calculate all the way up to age 70. And let's see, we have another question. What age must you be to file voluntary suspend? So that's one of the very unique situations where you have to have been born by January 1st, 1954. In order to have the higher earning spouse receive the spousal benefits of the lower earning spouse, they have to have been born by that year. If not, then the higher earning spouse would just simply collect their own benefit and they would forego any type of a spousal benefit at that point. But assuming that they do meet that birth date requirement, the higher earning spouse would then collect the spousal benefit all the way up to age 70. That's between the ages of 66 to 70. And then they would switch over to their own. And once they start collecting their own benefits, then their spouse would do the same thing. They would stop taking theirs and they would switch over to the higher earning spouse's spousal benefit. Let's see. Well, that's that's kind of a personal question for that particular person. It looks like there's a few personal questions, and I'd rather address them directly. You can always put those in an email or call our office, or you can even hold those to a time in which we have our scheduled appointment. If you would like me to put together a retirement plan, a tax strategy plan for you, or what I'm offering tonight at no cost is the Social Security report. You can save your questions if I haven't had a chance to answer them tonight and put them into the chat box, and I will answer those during our appointment. Or you can save them, write them down, and when we have our conversation, we can go over those in person. Just be sure to check the chat box, click that little link, schedule an appointment with me at no cost, and I can answer those questions, put together the retirement plan, the tax strategy plan, or even the Social Security analysis report that's going to be customized for you. I think that about wraps up our time. I appreciate this educational opportunity to share Social Security with you. I do put on other webinars that if you're interested, you can always check out our other events that we put on. But I appreciate your time, and my name is Corbin Lindsay, and be sure to sign up tonight for your meeting. After I sign off, you'll have about an extra 5 minutes to click, and that gift is only available to you, the Social Security Personalized Report, if you sign up tonight. That's the way that I can be most time efficient in helping you and be efficient with my business. Thank you, and you have a great day.